Welcome back to the channel. I hope all of you are having a great day. So today we're going to be talking about the yield curve inversion, why it's such a great indicator in terms of recessions and what could happen to the market, some yield curve control things that are very important, and what we're seeing in the Bank of England, the Bank of Japan, and over in Europe, and just some other very important things in terms of the interest rates, what could happen in the markets, and why all of this boring macroeconomic stuff is just so important at this time. But before we do get into it, make sure to like and subscribe down below, and I do have timestamps below as well for your guys' convenience, but let's get right into it. Now, the first thing that I wanted to get into, or really the most important thing in this video, is the yield curve inversion. This is basically one of the best indicators to show you when a recession is imminent and when it is coming. But before we actually get into this chart and go over why it's so important and so accurate, we have to go over a little bit of more context so you guys understand it a little bit better. So one of the important things to remember is that when you're buying bonds, the reason people buy them is because they're a very safe investment. The only thing with them is that typically you get less returns, right? You're going to get maybe like 3 to 5% returns on these bonds. And so people would rather put their money in the stock market because they're going to make more money from it. Well, when we are in a bear market and when things are not looking good, that's typically when people go with safer investments and are more risk averse, and so then money goes into the yields and people get more of a so safe return. Well, obviously a lot of this is going crazy because as the stock market continues to fall and the Fed raises interest rates, so does the rate of these yields as well, which is very important. Now, one example I want to go into is a thing called yield curve control. Now, I know this might be a little bit confusing at first, but basically there are two really big terms you guys need to know. So there's quantitative easing, which is basically when the federal government just pumps liquidity or pumps a lot of money into the market, making it easier to obtain money. And then that should allow the markets to go up because, again, there's just more money. Like imagine the pandemic when we got all those stimulus checks, people got free money, didn't really know what to do with it. So then a lot of people put it into the markets and that made the markets go up. Well, yield curve control is basically when a government looks at their yield curve percentage, right? Let's say right over here. And let's say they want to hit a target rate of 4%. Well, they're going to buy and sell as much bond yields as they need to in order to push those percentages to what their target rate is. Now, this is dangerous because if there are no buyers in the bond yield markets, that means the government is going to be the last buyer. And whenever they need to buy bonds, they're just going to print more money. And typically when they're trying to lower these bond yields, they're also trying to fight inflation. But if you're printing new money continuously, that just defeats the purpose, and so you kind of get this spiraling effect where we are currently at right now. So currently what happened is that the Bank of England intervened by buying a bunch of bonds. Now, an easy way to remember this is that as bond yields go up, that means the percentage goes down. So as more people are buying, or if there's a buyer in the market, the yield percentage should go down. And that's typically what happened. Bank of England intervened and bought a ton of these 30-year gilts, or in their term yields, which push the percentage down, and they were the only buyer. And then it immediately rose back to where it was. So they had a temporary fix for a long-term lasting problem, and they think just pumping liquidity in the market is going to fix their problems. You see the same thing with the Bank of Japan. They bought a bunch of their yields, which pushed it down temporarily, but they did not fix the main issue, and again, the yields rose right back to where they were. So this is one of the problems with yield curve control. You print a bunch of money and you only fix the problem temporarily, but long term, it's not good. Now, this is a really big problem because the current state of where we're at is a place that we've only been at two other times in history, 1931 and 1969. And this is when stocks and bond returns have both been extremely negative. I mean, you've got stock returns that are almost negative 20 and then bond returns that are almost negative 10. So this is showing that literally no matter where you put your money, you're going to be losing money. And these are also both really important times. Like I know, for example, in the 1969 example, this is when we got off the gold standard. And obviously that was a massive hit to the US dollar in the long-term survivability of it. Now, before this video gets all out of whack and I kind of get all over the place and I start rambling, let's go back to the yield curve inversion and why it is so important. If you look back in history, obviously this only goes back to 1989, so we can't look at past examples. But what I have here is I've divided the 2-year yields by the 10-year yields. And typically when this inverts, whenever the 2-year yields are greater than the 10-year yield percentage, there is a recession that is imminent months or possibly years later. Why? Because think about it like this. A normal yield curve should look something like this. Let's draw it up real quick for you guys. So we have the X and the Y axis. This is the yield percentage, how much you're going to be getting back. And then this is the time, right? So you've got your 3-month, your 2-year, your 10-year, and then your 30-year. You would think that as time progresses, you would get more yield percentage or more returns on your investment, right? If you're willing to invest in the United States economy for 30 years, you would probably get a 4% return. If you're only willing to invest in it for, let's say, 2 years, well, maybe you're only going to get a 3% return. So there's more of an incentive to invest in the US economy for a longer period of time. Well, as interest rates rise, that pushes up these short-term yields, which again are the 3-month, the 2-year, and the 10-year, right? These are also called notes. And as this goes and continues to rise, we come into a possible effect where the percentage is actually greater on these shorter term yields, which is again yield curve inversion. So it's less likely for people to invest in a long-term investment that produces less gains. But yet, if you only invest for 3 months or 2 years, you're going to get a higher percentage of return. And this is where you get your yield curve inversion. This is a very, very good indicator of recessions. It was really made popular in the 80s, but it serves basically all the way back to like the 1930s. So this is one really great example of kind of looking for possible recessions to happen and massive market downturns. And if we take a look back in history, again, I mean, I have all these marked up. This is the early 90s. We had a yield curve inversion right here where the 2-year yield was greater than the 10. So anytime this goes above 1%, it's showing us that the 2-year is greater than the 10-year yield, right? So that means you have more of an incentive to invest in the short term than you do in the long term, which just doesn't make sense. And then what we have is obviously the dot-com bubble, the great financial crisis. Obviously, it happened very, very slightly for COVID, but yet we did actually enter in the 2-3 month recession. The crazy thing is that we have reached levels that we've never reached before. I mean, if you take a look left, we've never been this high. The highest we've ever been is the dot-com bubble, which we know how inflated it was. And that was at 1.09%. Currently, we are at levels of 1.17%, which doesn't seem like a lot, but when you're thinking about it, I mean, just take a look at this. Like, if you look to the left, we've never been this high. So this is showing us that, one, yes, we are going to be entering into that recession. This is a really great indicator, and it's predicted almost every single recession. So why wouldn't it this time? And on top of that, we've never been this inflated before, where 2-year yields have been higher than 10-year yields at such an insane price. Now, this is the same exact chart, but instead of the 10-year yields, this is also the 30-year yields. And you see the same exact thing, right? We are at points where we've never been before. Now, this is a little bit better of an indicator because if you look during the COVID pandemic, it did not hit. So it didn't really serve as a proxy for a recession coming. But again, if you look back in the early 90s, dot-com bubble, great financial crisis, those are all times when this indicator hit. And again, if you take a look left, we've never been this high before. Telling you we're more inflated than we were back in the dot-com bubble in terms of the yield curve inversion. And again, one really big indicator in terms of short-term yields is whenever the interest rates or the federal fund rate goes up, so do short-term rates or short-term yields, which again, we know that the Fed is going to raise rates by 75 basis points. Well, I shouldn't say we know, right? But the market is indicating that there's a 98% chance that on November 2nd, we do get another 75 basis point rate hike, which is very, very bad because as these rates continue to go up, obviously it's to combat inflation. But the main problem is that these yields are going to continue to go up in the short term, which again, invert the yield curve inversion even more. And again, the main problem is that if inflation does not come down quickly or continues to stay up here, that's where we run into the problem of, what is the Fed going to do? Because this is the only reason that they're raising interest rates, right? They want to slow down the economy because they want to fight inflation. Well, as they raise interest rates, those yields go up. As those yields go up, then a lot of the stock market returns continue to dip. That's why we're in the bear market. And, we need a huge reset because everything is just completely out of whack. So I know this video is kind of all over the place. I know it was a little bit harder to understand. I'm still trying to understand it as best as I can and present it to you guys. Obviously, it's a very boring and dry subject. I mean, we're talking about macroeconomics, but these do serve as extremely important tools in terms of what's happening in the markets. But again, until they stop raising interest rates, that's probably a point when the market's going to keep going down. Once we actually top out and the Fed pivots, maybe at that time or months later, we can actually start to see something happen with the markets. But until then, risk assets are just going to continue to fall as the interest rates continue to rise, and they're going to keep rising until inflation comes down, which doesn't seem to be happening right now. So that's everything I have for this video. If you guys enjoyed it, if you found any value from it, make sure to subscribe and like the video down below. I would really appreciate if you guys could support the channel, and I'll keep educating myself and hopefully making better videos for you guys. But until the next one, I'll see you guys then. Peace.